Dear students, Assalamu alaikum. You are most welcome to my new lesson in the subject of accounting. The topics of double entry system. It's included debit and credit, the most important topics of accounting subject. You are staying in business studies group, so you have to learn how to determine debit and credit from each transaction. This is Mahmoud Hussain, Senior Lecturer, Department of Accounting, English Medium Morning Shift, Rajakuttara Model College, Dhaka. Today's our topics is double entry system. This lecture is for applicable class 11 business studies students and also for class 9 and 10 business studies students. Those who are come into new background, that is business studies group, they can take this lecture for overcoming or for understanding, for learning the subject of accounting. Dear students, at first you have to take your accounting practice copy for writing my speech or lecture or content. Now I am starting my lecture number 1 for double entry system. Basic concept of double entry system. Double entry system is the only scientific method of bookkeeping. According to this system, each transaction has two parties, receiver and giver. One party receives the benefit and other party gives the benefit. Receiver is debit and giver is credit. Each transaction changes the financial position of the twofold aspects of a person or firm. The basic concept of double entry system. Double entry system is the current system for recording of accounting system. This is the modern system or scientific system. Dear learners, now you have to know what is double entry system or what is the definition of double entry system. In ordinary sense, the system under which twofold aspects are considered, one party is debited and other party credited with the same amount is called double entry system. In broad sense, every transaction is measurable in terms of money or money's worth expressed in dual entity under double entry system. Through one account the benefit is received and through another account the benefit is given. The receiving account of benefit is called debit and the paying or giving account of benefit is called credit. Dear learners, I think we are writing the definition of double entry system in your accounting practice copy. Throughout the world, double entry system is established and known as dependable, scientific, and complete system for keeping accounts in the business. In double entry system, each transaction that measured or measurable in terms of money is expressed in dual entity. There is no alternative method of double entry system to know the actual result and actual financial position of business. The famous mathematician Luca Pacioli described the perfect and proper recording system of financial events in 1494. That system is known as double entry system. There have been two or more accounts in every transaction. These accounts are written in dual entity concept. One is debit and other is credit. Two parties of transaction, that is, debit and credit, are recorded in accounts by double entry system. Principles or characteristics of double entry system. The first one is dual entity. Second one, receivable and payable. Third one, debit and credit determination. Fourth one, exchange equal amount of money. Fifth one, comprehensive result. That is, since in every transaction the debit and credit are analyzed and recorded in equal amount, it is easy to deduct the comprehensive result. The total of debit side should be equal to the total of credit side. Dear learners, now we can know what is meant to debit and credit, the very important item for this chapter for accounting. Debit and credit are used to monitor incoming and outgoing money in your business account. In a simple system, a debit is money going out of the account, whereas a credit is money coming in. Dear learners, the very simple definition for debit and credit. You have to write it for learning the definition of debit and credit. Another important definition for debit and credit. A debit is an accounting entry that either increases an asset or expenses account or decreases a liability, equity, or revenue account. A credit is an accounting entry that either increases a liability, equity, or revenue account or decreases an asset or expense account. That is, when asset or expense is increased, then it is debited, and when liability, equity, or revenue account is decreased, then it is debited. On the other hand, when the liability, equity, or revenue account is increased, then it is credited. But when asset or expenses account is decreased, then it is credited. Dear learners, I think you have understood the definition of debit and credit. Now, you have to know another most important item, rules for determining debit and credit. A procedure of identifying debit and credit. Two rules are available for determining debit and credit. The first one is modern rules or current rules, that is American rules. Or moving balance or current rules. You know, totally 5 types of account are there: asset, liability, equity, revenues or incomes. Fifth one, expenses. Then when asset is increased, then it is debited. And then when asset is decreased, then it is credited. Second one is liabilities, and liability is increased, then it is credited. But when it is decreased, then it is debited. The same rules for equity and revenue. When equity is increased, then it is credited. But when equity is decreased, then it is debited. When revenue or incomes is increased, then it is credited. But when revenue or incomes is decreased, then it is debited. The same rules for expenses of asset. When expenses is increased, then it is debited. But when expenses is decreased, then it is credited. These are the current or modern rules for determining debit and credit. Dear students, I think you have copied the formula or procedure by identifying debit and credit for modern rules. Now, I am showing the golden rules for debit and credit, or traditional rules, or British concept, and old rules. You know, 3 types of account under golden rules: personal account, real account, nominal account. For personal account, receiver is debit and giver is credit. For real account, what comes in, that is debit, what goes out, that is credit. For nominal account, all expenses or losses is debited and all incomes or gains or revenues are credited. Loving students, I think you have understood the rules for determining debit and credit. Both rules are applied for determining debit and credit in the time of transactions, journalizing, or determining debit and credit, or recording procedure. Now, how to determine debit and credit? There is the stage or steps of determining debit and credit. At first, analyze the transaction and then answer the following questions. Number 1, what is being exchanged or changed? Number 2, what accounts are affected? Number 3, which of the accounts is increasing or decreasing? Number 4, which account is debit or credit? If you know 4 questions, if you know the answer for these questions, then you have to determine, or you will determine debit and credit for each and every transactions from the business transactions. Dear learners, now we can give the very important example for determining debit and credit. The 10 transactions are available for determining debit and credit. Number 1, an Almira purchased in cash, values of Taka 20,000. You know, an Almira, one kind of asset, that is name of furniture. Almira purchased in cash. So when Almira purchased, then asset increased, that is furniture increased, and another one cash decreased, that is asset decreased. So for this transaction, furniture account debit and cash account credit. Note for this transaction, asset or furniture increased and asset or cash decreased. Let us remember Almira, that is furniture account in all time. On the first transaction, an Almira purchased in cash, values of Taka 20, debit and credit, furniture account debit, cash account credit. Second transaction, cash brought in business by owner Taka 3 lakh. For this transaction, cash in business, that is cash, one kind of asset increase, and cash brought by owner, that is the capital amount is brought in business. So cash increasing into the asset increasing. When asset increases, then asset account is debit and capital is brought. When capital is in business, then equity increase. That's for cash account debit, capital account credit for this transaction. Note in this transaction, asset or cash increased and equity, okay, that is capital increased. Remember, brought or invested by owner in business, that is the amount of capital. Number 3, goods purchase values of taka 5,000. In this transaction, two accounts are involved. For goods purchasing, that is the purchase account, and for goods purchased by what? That is the cash has gone from the business. So purchase one kind of expense increasing, that is purchase account is debit and cash has decreased, so cash account is credit. Note for this transaction, expense or purchase increased and that is asset, cash decreased. Remember, for buying goods in business, that is the purchase account. Number 4, goods sold by cheque of taka 90,000. In this transaction, two accounts are involved, sales account and bank account. Bank account one by asset, one kind of asset, and sales account one kind of revenue account. Bank amount is increased and sales amount, that is revenue, increased. So bank account debit and sales account credit for this transaction. Note, in this transaction, revenue or income, that is sales, increased and asset, that is bank deposit, increased. Remember, for selling goods in business, that is sales account, and check related transaction, that is bank account. Number 5, salary paid to manager for the month of January, taka 20,000. In this transaction, two accounts are involved. The first one is salary expense account, another one cash account. For salary paying, that is expense increased, so expense account is debit. And for salary paying to manager, so cash decreased from the business, so cash account related. For this transaction, salary expense account is debited and cash account is credited. Note, in this transaction, expense, that is salary, increased and asset, that is cash, decreased. Remember, for paying amount of any regular expenses, respective expense account is opened and without information. It is a cash transaction. Dear learners, I think you are writing in your copy in proper way and listening my speech or discussing about this transaction. Now number 6, loan taken from Imran or Rana Co. Loan taken from any other source, then two accounts are involved. Number 1, cash account, another one loan account. Cash is increased in business, so cash account is debit. And loan taken for this amount is liability increase, so loan account is credit for this transaction. In this transaction, asset, that is cash, increased and liability, that is loan, increased. Remember, for taking any amount of loan from other person or institution for business, cash and loan accounts opened. Number 7, commission received in cash. In this transaction, two accounts are involved. For receiving cash account, and commission receiving, that is commission revenue. So when cash increase, then cash account is debit, and when revenue increase, then revenue account is credit. For this transaction, cash account debit Commission revenue account credit. Note, in this transaction, asset that is cash increased and revenue that is commission increased. Remember, for receiving any amount of regular activity of business, this may be revenue or income of business. Number 8, cash deposited into bank or bank account, taka 10,000. In this transaction, two accounts are involved, bank account and cash account. For depositing money into bank, that is bank account is increased and cash has decreased. So bank account is debit and cash account is credit for this transaction. Note, in this transaction, asset that is bank deposit increased and asset that is cash decreased. Remember, for opening an account into bank or depositing cash into bank, asset of business is unchanged. Number 9, withdraw from business by owner taka 2,500. Withdraw, that is drawings. In this transaction, two accounts are related, drawings account, another one cash account. Drawings account debit, cash account credit. Note, in this transaction, equity that is drawings equity decreased and asset that is cash decreased. Remember, for withdrawing or taking money from business by owner, drawings account is opened. Dear learners, note and remember is given only for you for understanding very easily. Number 10, rent due or outstanding or unpaid or accrued or payable for the month of taka 8,900. If rent paid, then to be opened, rent expense account debit and cash account credit. But in this transaction, saying no rent due, that is rent unpaid. So two accounts are involved in this transaction, rent expense account debit and rent payable account credit. Note, in this transaction, expense that is rent decreased and liability that is payable increased. Sorry, in this transaction, expense increased, rent increased and liability that is payable increased. Remember, for unpaid of business, respective expense and expenses payable accounts are opened. Dear learners, for the first lecture of double entry system, that is topics of debit and credit, I have already discussed in the topics of double entry system and debit and credit. I hope you have understood the whole lecture of double entry system. If not, you have to listen more and more very carefully. Read attentively and practice properly. Dear students, thanks for being today. Allah Hafiz.